Hey everyone, welcome to the Juniper Links accounting channel. My name is Caroline and today's video is capital gains tax explained. So this is going to be specifically for the UK and we're going to look at the current tax rates and thresholds as well. So I'll have actual examples of how you can calculate a capital gain. And just a quick note, obviously we're not providing tax advice, this is just for information purposes so you can have a better understanding of what to do with your capital gains when you receive them. So without further delay, let's get started with the video. So first things first, what is capital gains tax? And it is essentially a tax on unearned income. So you've got earned income, the income that you normally receive as a direct result of working. Unearned income, on the other hand, is income earned from investments. So for example, when you sell or dispose of an asset, and HMRC refers to it as disposing of assets, and we'll have a look at this definition in a second. And more specifically, capital gains tax only applies to the gain or the profits when you sell the asset. And before we get into that, here are some examples of chargeable assets or investments. So when you sell a property, income from stocks and shares, so not when you receive dividends, but when you specifically dispose of the stocks and shares. And again, we will go through what disposing means in a second. Cryptocurrencies are another type of assets. Business assets, so if you are a sole trader and you have sold assets as a part of the business, then capital gains tax would arise from that. And of course, personal possessions worth £6,000 or more. So if you have personal possessions under this amount and you've just sold your own stuff and it's not that much money, then you don't have to calculate any kind of gain on that. And of course, this excludes your car. So those are some examples of the types of investments or chargeable assets that would be subject to capital gains tax to give you a better idea. Let's look at how an asset is disposed in that case. So this disposed word or disposal basically can mean a lot of different things. And the most obvious example is when you sell an asset because you are physically getting rid of it. If you exchange an asset for a different type of asset, it basically means, from HMRC's perspective, that you have discarded or disposed of the asset and used those funds to then buy another asset. So the disposal did take place even though it's been replaced by something else. And unfortunately, that does mean for cryptocurrency, if you exchange one type of cryptocurrency for a different type of cryptocurrency, it does count as a disposal, and you would need to account for the capital gains on that disposal or on that trade. If you decided to gift an asset to someone else or transfer it to them, apart from spouse or charity donations, then a capital gain would arise as well. Just note with the charity donations, there are some specific rules on that. So for example, if you're expecting to receive something in return for your gift, it wouldn't usually receive the same sort of tax relief. And finally, if you receive insurance compensation for an asset that was lost or stolen and you receive a payout for that, then you would need to calculate the capital gain. So if somehow you receive more compensation for the asset than when you bought it for, that profit would have to be accounted for as a taxable gain. So now that we've got all of the definitions out of the way, we can have a look at the actual capital gains tax rates for the current tax year. The first thing you will notice is there's a tax-free allowance of £12,300. And if you receive gains that are under this £12,300 allowance, there would be no tax to pay. Next, we've got the basic rate tax of 10%. And these are for regular assets. So for example, shares, business assets, cryptocurrency, things like that. With property, there are specific different rates. So just keep that in mind. In the higher additional rate, we've got 20% on normal asset disposals. And then of course, with property capital gains tax, it's 18% in the basic rate and 28% in the higher or additional rate. And the cool thing about capital gains is that the rates are determined from your normal income received during the tax year. So it depends on your regular earned income, like how much salary you received. And even if the capital gains that you receive take your total income over the £100,000 threshold, it wouldn't affect your personal allowance for the year. So your personal allowance is your normal tax-free allowance on earned income. So for the current year, that's £12,570. So let's look at an actual example of calculating your gains or profits Let's say you purchased 10 shares on the 1st of May 2017 for £10,000. So just a really simple example. And we sold 5 of those shares in July of 2021 for £20,000. So there's quite a difference going on here. The date that you sell the shares determines what tax year you need to report it in. So just keep that in mind. If you sold shares in March of 2021, that would be for the previous tax year ending 5th of April 2021. However, this particular example that I'm pointing at now wouldn't be reported until after the 5th of April 2022. And finally, let's say that the total fees and stamp duty on that sale or disposal, £1,350. So 5 shares sold during the 2021-22 tax year for £20,000. And then we can take away, so less is like subtraction or deducting, the allowable expenses, which involve the purchase price as well as the fees that you were charged. So, for example, the purchase price in this case, since we're only selling 5 of the 10 shares, which were initially £10,000 in total for all 10, would actually be a £5,000 purchase price. And then we would need to add the total fees and stamp duty to that £5,000. So this is where the £6,350 comes from. And once we deduct that, we get a total gain of £13,650. And now we can actually report that gain on a self-assessment and calculate the appropriate income tax that would be payable as a result. That is what I'm going to give you in the next example. So let's say that total gain you received of $13,650 was added to your return, and of course there is the tax-free allowance that we get to take away from that, which is an allowable deduction again. And the total taxable gain that you're left with is £1,350. So if your other income is over the higher rate tax threshold, which for this year is £50,270, the tax rate would be 20%. So that would give us total tax liability of £270, and your total gain was £13,650. So not a bad deal. In the lower rate tax thresholds, if your salary, for example, was just $30,000 for the year and you had no other income, the capital gains tax in this case would be 10% instead. So the total tax would be £135. And again, not a bad deal. Both of them aren't ridiculously crazy, but obviously in this particular example, most of the gain has been taken up by the tax-free allowance, so it makes it overall very tax efficient to receive capital gains of this value. So now if we know that we have a capital gain and we're going to have to pay some personal tax on that gain because it's over the tax-free allowance for the year, how do we actually report that to HMRC? So most gains would be reported on your self-assessment tax return. That's the most straightforward method, and it would be done once a year. So the tax year runs from 6th of April 2021 to 5th of April 2022. And if you had any disposals during this time frame, you would need to account for the capital gains on those disposals, where applicable, of course. And if you're not sure, then I do recommend speaking with a tax advisor that can help you with your self-assessment in this way. So if you know that you can report your gain simply through a self-assessment, so normal business asset disposals and shares and things like that, then you can register for self-assessment with the SA01 form, which I will link in this video below. And this is just the standard self-assessment application to tell HMRC you have other income that you need to report. And with properties that have been sold after the 6th of April 2020, which was a more recent change, HMRC has created a capital gains tax on UK property account, which you can report your gain through. And this is done within 30 days of the disposal or the sale. And these are all the helpful links that I've got that'll also be in the description below. The capital gains tax general website for HMRC can be found first, and that one will literally just go through a lot of different sections of what are capital gains, how to report them, what type of gains you should be reporting, and things like that. Shares follow a slightly different method of reporting capital gains, although they are also done through your self-assessment. But there can be more complex accounting issues involved with shares, especially on the frequency of how often you sell them. And there's a second webpage to help with that as well, which is HMRC's internal guidance. So those two are for the shares. And then you have the capital gains on UK property, and this is the specific link to that account that they've made to report your gain within 30 days of the sale. Finally, we've got the Register for Self-Assessments SA1 return, which you can find here. Thanks so much for watching to the end of the video. Of course, we are an accountancy practice, so if you are running your own limited company and you need help with your accounts, do feel free to contact us. And if you did enjoy the video, feel free to click that like button so we know we did a good job. And finally, if you want to see more videos like this, then don't forget to subscribe to the channel and click the notification bell so you can get notified every time we upload a new video. Thanks again for watching, and I hope you guys have an amazing day.